Super. Again, really sexy. Look at that. It's a ledger. But by the end of this, I'm going to show you why it's so important. Now let me show you just the first thing that comes up. If you go to Google and you just type in stone tablet bookkeeping, one of the first results you're going to get is from the Singapore Government Services. And it says, what is blockchain? Blockchain is a giant stone tablet in the sky with inscriptions that everyone can see. I mean, how cool does that sound? Who else wants a giant stone tablet just flying in the sky? Hey, a couple of people. That's cool. Now, let's figure out why that even exists, why this description. This is a fairly accurate description of a lot of blockchains. You know, there's some that have maybe smart contracts. They have some more functionality you can program in. But at a high level, most of the blockchains we're going to see, and most of the companies we're going to look at investing in with ICOs and the likes, really are fundamentally solving this objective of a giant stone tablet in the sky. And so, why is that? Let's start off with a story. Anyone here heard of Enron? One person, a couple people. Okay, some of the old, yeah, you know. Okay, well, for those of you who aren't familiar, Enron was a very, very large public company for a long time. They did a lot of stuff in financial markets and in the futures markets. I could talk all day about them. I'm a finance geek. They did a lot of really cool things with finance. And as you can see, from about the 80s to sort of the end of the dot-com era, they did really, really, really well. Their stock went from effectively a couple of bucks to over $80 or so a share. And that made a lot of people a lot of money as the company grew. But the way it grew was a little bit, we call it not so honest. In one of their annual meetings, their CEO, around about that they were at one of these really high price levels, the CEO came up on the stage in front of every single employee in the company. It was an employee mandated meeting. And he told everyone they should invest all of their 401ks in the stock and buy. And as their CEO was saying this and giving this disclosure, within a week, he had sold millions of shares of the company, and it was just a disgusting reverse play that he made, really at the expense of the shareholders. And so the question is, well, how did this happen? Why did this happen? And to answer that, I'm going to show you guys this factory that Enron built in partnership with GE and some other manufacturers. They sunk a couple $100 million into this project in the kind of a remote part, but kind of a populated part of India. And when they built this project, they received approval for a bookkeeping method. You're going to hear bookkeeping a lot in this lecture. It's going to be boring. But this bookkeeping method, when they received approval from the IRS to use what's called mark-to-market bookkeeping, I know it's boring, but just hold with me. It basically means they sign a contract for $10 million over the next 5 years. Oh, we made $10 million today. Nothing questionable about it. When they built this factory, they used that mark-to-market bookkeeping to book hundreds of millions of dollars in profit and post that onto their corporate books, which then they used to inflate their stock price. And they did a lot of really other nasty stuff. They created a lot of entities outside of Enron itself and then convinced the banks to loan those entities billions of dollars, which is completely illegal because it keeps it off the books of the public company. They did just a lot of illegal accounting things. And that's where bookkeeping starts to come in as this really, really important thing. Now,
oh, the weather outside is frightful, but the fire is so delightful. And since we've no place to go, let it snow, let it snow, let it snow. Man, it doesn't show signs of stopping, and I've brought me some corn for popping. The lights are turned way down low. Let it snow, let it snow.
It's not like the end of the world. It just kind of represents how Enron came crumbling down, and that is coming down to the shredder. So basically, on this one very fateful day, everyone started to realize, in looking through Enron's books, that a lot of the numbers weren't making sense. And on that very fateful day, the company, so every public company has a firm that audits all their books. That's just the standard. You have an auditor. Anyone heard of the Big Four? What? Yeah? A couple of accounting geeks? Okay, cool. Before Enron, it used to be called the Big Five. You had the Big Five accounting firms, and that fifth one was called Arthur Andersen. And on the day that the press came out that there's something weird going on with Arthur Andersen's books in Enron, basically they just started shredding masses and masses and masses of paper. And so this is kind of funny. They have these guys in corporate offices shredding paper and throwing it down like it's snowing outside as they effectively shred decades of sensitive data that was altered and all these sketchy transactions where they moved the debts off the corporate books or where they booked billions of dollars in profit. A lot of times, like with that factory in India, it actually never really produced almost any revenue because nobody could afford the electricity where they built it. It was just, it was a very silly thing to do, and yet they just did it because, oh, we can book a bunch of money from it and pump up the stock price. And at the end of the day, they had, the insiders, really everyone that was making money was doing it through some form of securities fraud. And that's why they shred basically all of the paperwork for the company in a very quick fashion. And that's also how Arthur Andersen dropped out of being a public accounting firm, which is a big problem. So I just want to tell you guys this as we sort of come into the sphere of the world where Bitcoin emerged from, this idea of sort of the Great Recession, which was a little bit afterwards, but a lot of it was caused by fundamentally the same problems that plagued the bookkeeping in Enron. A lot of it was caused by people selling stock that didn't really exist. And at the end of the day, that comes down to naked short selling. And that's the environment that Bitcoin came up in. And that's sort of the environment where all this cryptography came together to build a triple entry accounting ledger. And so that's how we get to finance. Now, I want you guys to understand with most cryptocurrencies, and especially with Bitcoin when it first came out, it really was just a different way of looking at an existing problem. Has anybody ever seen a spirally brick wall like this before? Anybody? No? A couple people? You guys abroad? You from the U.S.? Yeah. From the U.S., really? How about you guys? Really? So most of these walls are a little more popular in Europe. And the cool thing about these wavy walls, they might not look traditional, but they actually use about half the bricks of a normal wall because to get the stability across it, instead of using 2 rows of bricks, which is how most walls is made with bricks, in the U.S. at least, they use this wavy design which gives that horizontal stability, and it uses about half the brick. So it's really just a different way of thinking about a problem that we have, which is how do we build a wall? And that's exactly what we see with these blockchain ledgers, what they did with accounting. So we're going to start at square one, okay? Single entry bookkeeping. Anyone here ever have a checkbook? Anyone ever write checks when you were a kid? Yeah? It's a little bit sad that, alas. So if anyone's ever balanced the checkbook, basically you have sort of your transactions, but the important thing here is the credits and the debits. It's all a single entry on the same account. You have this one account, which is your bank account, that you're drawing checks on, you're giving checks from, and all of your credits and debits, all the bookkeeping executes in that one central account. It's all on one ledger, and that's basically what single entry bookkeeping was. This is what stone tablets were for thousands and thousands of years. This is how most of bookkeeping was for most of time itself until about the 1800s, when someone was like, hey, what if we used double entry bookkeeping? Now, I know we're talking a lot about bookkeeping, but hang with me because this is really where it ties into all of blockchain. So it's double entry bookkeeping. Instead of having just one account where you have the credits and the debits from that one account, instead, when you're counting, you have a debit and a credit. Has anyone ever heard of double entry bookkeeping? No, not many. A little bit. Okay, so I'm not preaching to the choir. So you'll have this debit, and the important thing about this debit is this debit comes out of an account for cash. So this cash is an account. Trucks is an account. Service revenue is an account. Accounts receivable. These are all different checking accounts. So you have multiple accounts instead of it all just being on one account. You'll see that when the money comes out of one account, it gets added into another account. This is how a vast bulk of any kind of bookkeeping has functioned for hundreds of years. This is really just the de facto standard for bookkeeping. You have the debit in one account, you have the credit in another account, and you can match them. They always match. So you have the credit in this account comes from this other account, and you can see that in both the accounts. You can see that on the books, and you can see that on the ledger. And this is what Arthur Andersen's job was as an auditor. They would come in and they would make sure all the debits matched all the credits matched all the debits, and so forth. So you can see, say we have Alice, say we have Bob, you can see Alice has an expense of 100, and then Bob comes and takes in 100. That is the foundation of double entry bookkeeping. And then right here what we have, this is traditional triple entry bookkeeping. So we're going to introduce some new terms here. The most important one, you got the auditor, you got the bank facilitates the transaction. Okay, sure. There wasn't really any way to do it outside of a bank for most of the time. The auditor, just think Arthur Andersen. The biggest thing though is this receipt. This receipt is crucial. This receipt is critical, and that's what makes this a triple entry accounting system. So not only do you have the double entry transfer here, but then you have the auditor, you have the bank come in, and they issue a receipt for that transfer. So Arthur Anderson attests that this cash came out of Alice's account and went into Bob's account. And that attestation, that receipt, that's basically the foundation of all accounting for public U.S. companies, which are more highly regulated. If you're familiar with like the Great Depression, a lot of that was some really sketchy accounting, some really poor double entry bookkeeping led to a fair bit of those challenges that led to that crash. A lot of it just came from basic underlying accounting. And so these receipts really solved that problem, especially sort of in the late 70s. You had these receipts from these auditors really start to grow in popularity. And those receipts were triple entry bookkeeping. They were the guarantee that, yes, this is actually what happened in the double entry books. So just to put this in perspective, if you wanted to fraudulently state the balance of a single entry book, all you have to do is just lie about one little item, right? It's like super easy. You can say, oh, I got $50 less, and the IRS can only tax me on, less 50 because that's what it says in my account. I just changed the book. And there's no other place to verify that. Similarly, with double entry books, say Alice and Bob collude and they say, oh, I'm going to launder some money and I'm going to say that I received $1,000 and I gave you $1,000 when I only gave you $250, and I'm going to keep that money and use it to fund some nasty stuff. When you have that triple entry book, all of that fades away, assuming trust in the auditor, assuming trust in the receipt. So long as you have a trustful auditor, a trustful receipt, you can't just lie and say this was $400 but keep $300 and just send $100. So that's really where these receipts come in, and that's what Arthur Anderson and all these other accounting firms are supposed to verify are these ledgers. But as we've seen with Enron, that crumbles down. For Enron, it crumbled down because they were paying Arthur Anderson millions and millions and millions, very large sums of money for their accounting, and that enticed them to kind of falsify, just muck the books a little bit, which in the end, as we saw with the drastic crash in the price of the company stock, resulted in, it's just heartbreaking to see how many people lost their entire life savings when Enron crashed because they followed that advice of investing all their money in Enron. I could talk a lot more about it. It was just heartbreaking to see, and it really hurt a lot of investors once they came out that these receipts were fake and these books were fake. So that's when we start to come in to protocol. Now, anyone raise your hand if you played Team Fortress 2? Heard of Team Fortress 2? Couple, maybe half? Okay, cool. Anyone ever trade in Team Fortress 2? A little bit? Okay, maybe a couple people. So Team Fortress 2 is just a video game. It was one of the first video games to really have its own economy. Around 2008, sort of around this same time frame when it came out. And what you could do is you could trade with other players. You had these in-game items, you could trade with other players, all right? Basic stuff. And the way it works is you have this box here, say this is Alice and this is Bob, and Alice will say, I'll give you this sword and I'll give you this hat if you give me this wrench and this knife or something. And so Alice puts her items in the box, and this green box here will be unchecked. And Bob puts his items in the box, and when both parties are ready to make a trade, Alice checks ready to go, Bob checks ready to go, and there's a button that says execute the trade. Anybody can press it once both the boxes are checked. Now, if any time during this whole ready to go phase, Alice removes her sword, the boxes become unchecked and the trade doesn't happen. It's not verified, it's not ready to go because she's changed the trade, and that's kind of just how the system works. And you have this chat box where you communicate with each other. This system has processed millions and millions and millions of trades of these virtual in-game items without a hitch because it very transparently shows this is what you're giving and this is what you're getting. And you both have to agree to both sides of it. That's it. There's no lying, there's no cheating, there's no other way around it. It's like a basic transfer. And so that's just kind of an underlying protocol. And what you'll notice with this protocol is that there is no middleman facilitating anything. Has anyone ever bought a stock before? Anyone bought a stock? Yes! Yeah, fun. Okay, cool. So just yell it out to me. Where do you buy your stocks through? Who do you buy it from? Fidelity, brokerages, right? So those brokerages are the first of many middlemen that you're going to go through when you make any kind of financial trade like that. On average, you're looking at about 8 to 11 middlemen in between you and the other buyer on that trade or the corporation on the trade issuing the stock. There's a very large amount of middlemen in that trade. And what you'll notice is that with this trade, there is no middleman. It's just a protocol that you trust. That protocol, granted, is built by a company called Steam. Everyone ever heard of Steam? They're the ones who made the game. So Steam builds this protocol, and they say, hey, this is our engine, you guys trade on it. Versus maybe more so in financial markets, you have just a disgusting amount of middlemen in the middle, and they all take a little cut off that, right? You have to pay just a little bit to come to the table. And it might not look like, maybe if you have low commission, maybe you have free commissions, it might not look like you're paying them that money, but in reality, as everything gets routed in the back end, you're paying that money. I can promise you that from a lot of experience. And so now we're going to look at where this receipt comes in. So again, think about the protocol built in this video game for trading items. That protocol came from this company. They said, this is our protocol, and that's it. You guys can judge it for what it is. If you don't like it, don't trade on it, whatever. But when you have these receipts in more of an intermediated market with more middlemen, all of a sudden now you place that trust not on the protocol itself, but instead on issuer's authority, their attestations, those receipts that we saw when we looked at triple entry books, those receipts that attest to, yes, we have this warehouse receipt for cotton, we have 100 kilos of gold sitting in this warehouse somewhere. If you trade this contract and you own it on the last day, you will receive physical delivery of these 100 bars of gold. Anyone ever trade a futures contract? Anyone? No? It's a whole other animal. That's probably for the better. And we'll show another example here. This is just an example with a shipper. So say you go to port in Los Angeles. They give you sort of a warehouse receipt. This is a warehouse receipt for a company called Fraudulent, and they say, I attest that we are paying so and so much money for, in this case, it's some vans. And this is a receipt of that transfer. So this receipt is attesting that Alice gave Bob 100 grand and Bob gave Alice 15 vans. This receipt is attesting that Alice gave Bob 100 grand and Bob gave Alice a bushel of grade A cotton. Those receipts come from those middlemen versus that protocol. And that's really where you see Bitcoin, these blockchain technologies fit in. They're effectively implementing this idea of triple entry accounting, but instead of placing central trust in travel and tours, instead of placing central trust in intercontinental exchange, instead of placing central trust on this receipt for the transaction itself, you take that trust, you remove it as much as possible so that everything boils down to the protocol. Everything boils down to the fundamental system that everything uses. So everything boils down to, hey, do we trust Bitcoin? And then the question, do you trust Bitcoin, for example, comes down, for a lot of people, I've heard a story. When we were running the fund, I heard a story of a hedge fund manager. He was kind of skeptical about Bitcoin. It was about 2015, and he was like, it's a little bit sketchy. I don't know if I want to invest in that. And so what he did is he hired a team of about 6 professional coders, 6 professional hackers, and for 3 months he just had them work and trying to break Bitcoin, trying to hack Bitcoin. He paid a couple $100 grand for it, and at the end of 3 months, the hackers came back and they said, look, we couldn't do it, we couldn't hack Bitcoin. And after that, it's rumored that the particular manager invested about 300 or so million into the digital currency, which it did pretty well. That kind of protocol trust is what you want to see when you replace these accounting receipts with public ledgers. And that's what you see with Bitcoin. And that's the whole point of everything that we do here is in blockchain and in any kind of crypto space, is you're taking, for example, say we have like the Bitcoin ledger here, the Bitcoin blockchain here, some trusted blockchain ledger that's based on a protocol, not a central middleman. Like no one knows who's Nakamoto, right? It's all based on the protocol and the code and the implementation of triple entry blockchain accounting that we all face as this new receipt, and additionally as the guarantor of the double entry bookkeeping. So that's the key, and that's the foundation of everything that we do. And everything blockchain does at its core is not some magic internet money. It's really, at the end of the day, just a triple entry account ledger with cryptographic guarantees. So you use cryptography as the receipt, which of course is just math, right? There's no math company that owns all the receipts. Instead of, say, some middleman that authorizes that receipt, because middlemen fail, as we saw with Enron. But cryptography, anyone here know quantum computers? A little bit, been familiar? So some recent estimates show that it would take, if we could produce a pretty sizable quantum computer take about 200 quadrillion years to break, just like SHA-256. And you have more developments and so on down the road, and everything's open source, you can improve it all. But at the end of the day, the point is that it's all significantly more, it's just like a whole new level of security. It's comparing, for instance, anyone ever seen that movie about the trader who almost bankrupt this entire European brokerage firm? No? So it's crazy. This guy had control over hundreds of millions of dollars for this brokerage firm in Europe. And he basically bet all of it wrong, but he kept lying and lying and lying about how much money he'd been making. And the way he did it a lot of the times, or at least in the most significant time, he had like a $500 million off of this. He took someone's signature and like cut it out of a document and then kind of glued it onto a piece of paper that said that, hey, we have this account, and then faxed that in. And that fraud cost hundreds of millions of dollars. And so when you remove the ability for that central receipt and that central guarantor to create kind of falsifiable books like that, and you replace it with some of the cryptographic, next week we'll really dive into a lot of the underlying cryptography. When you place it with that underlying cryptography, you create a new ecosystem and a new ledger where the cost isn't determined by some arbitrary middleman charging arbitrary margin. It's not determined by how much does Arthur Anderson charge per year. How many hundreds of thousands of dollars are you paying to Arthur Anderson? How many millions of dollars are you paying to Arthur Anderson? And instead, that verification and that trust, at least with public blockchains, which, in my opinion, are really the only real blockchains, it comes from the network itself and the protocol, so that you don't have to pay all of that money for those expensive receipts and that expensive guarantee of your triple entry account. And that is the core of all the blockchain technology we're going to talk about. And I'm excited next week to dive into the cryptography on all of it.